right. Good afternoon. Good afternoon. Let's get IG on here. How are you guys doing out there today? All right, we're live on IG. Hello, hello. How are you guys doing? Good afternoon. Elaine Proby here, CEO PROBY'S Tax and Accounting on this lovely Thursday afternoon. It's just a little cloudy today, but of course there's no more rain. So anyway, hopefully it's this is nice wherever you are today. So I want you guys to hit like and share on this video. This is so important right now because it is talking about the new tax law changes. Usually when it gets to this time of the year, the IRS and everyone always come up with what is going to happen for the new tax season, which is tax year 2021. And so they have already discussed what's going to happen, what kind of changes they're going to put in place, you know, because they have to get ready for the new tax season. Of course, right now their computers are all shut down because they are updating and putting all this new info in there. So we want to discuss on 3 of the most common things that's going to affect us that we are very familiar with. There's a lot of different tax law changes that's happening for 2022. However, I just want to talk about the ones that are going to be the most common for most of us. You know, there's a lot of other things, but those a lot of it may not even relate to you. So so today, new tax law changes for 2022 that's going to affect most of us, and in a very good way. Normally there's tax changes, there's tax increase, and all we hear is, oh my God, taxes are going up and we're going to be paying more, they're going to take up more. And so usually that is the conversation that we have, right? But this time around, because of inflation, these changes are more favorable than they have been. Okay, they are more favorable. So I am so excited to discuss this with you, because anything that has to do with saving taxes, anything that has to do with us paying less taxes, is obviously more favorable. It's a much more exciting conversation, right? Than the taxes are going up and we have to pay more. So today we're going to talk about 3 different things that's going to be changed in 2022 when you file your taxes for 2021. That's going to affect you. And these, of course, guys, are, I believe, the ones that's going to affect most people, right? Most people. There's other things, of course, but this is going to affect most people. We'll talk about the standard deduction, and now that you know exactly what that is. We'll talk about the new tax bracket, which is going to be more favorable than it has been, which is great. And then we talk about this earned income credit, which is refundable money that most people get, but that has a dependent. And even if you have no dependent, there's a credit that you can still get back anyway. So those are things we're going to talk about today. Again, hit like and share. Thank you guys for jumping on here. Once again, I want to jump right into these topics today. Hey, Cognac, thank you for jumping in. All right, all right. So let's talk about, first of all, we'll want to talk about the first point today is standard deduction. We want to talk about standard deductions. And of course, guys, let me explain to you what is standard deduction, because once again, you know, all this stuff, because we have just got our taxes done for the most part, and then we don't even understand any of the terminology for the most part. So people talk about standard deduction and you, of course, don't know what that is. So I wanted to explain to you guys the first point today, which is about the new standard deduction. And I'll let you guys know what standard deduction is. And it affects each and every one of us, but more so, standard deduction is the amount that you could deduct from your earnings before you pay taxes if you do not itemize, right? So that's the first point I want to make, because most people don't understand what the standard deduction is. Hey, Lerner, thanks for jumping in. They don't know what is standard deduction. So the amount of money that the IRS allows you to deduct from the monies that you earn before you pay taxes for the people who do not itemize. Now, when I say itemize, there are some people who can itemize, which means that they write off more expenses from their earnings before they pay taxes. And these are people who have deductions like, say, mortgage interest, property taxes, insurance premium, people who have given major donations, stuff like that. And then standard deduction, people who does not have a home, who can't write off mortgage interest, property taxes, who is not, giving a lot or paying a lot of health insurance premiums and things like that. They're not able to itemize. But what the government has done, there is the standard deduction that they allow you to deduct from the monies that you earn. And a lot of people are not able to itemize anymore because they are not able to take off the miscellaneous deductions anymore, like your uniform cleaning and all that good stuff. You're no longer able to write that off. So some people are not itemizing at all. People who used to itemize are no longer itemizing. So that's what the standard deduction table is for the people who don't itemize. Okay. So let me give you an example. If you made $30,000, the standard deduction now for a single person have gone up from $12,950, gone up to $12,950, which is $400 more than it was last year. Which means that, let's say you made $30,000, guys, you get to deduct $12,950 from your $30,000. And now you only have to pay taxes on the difference, which is $17,000. That's what standard deduction does. It reduces your income. So now you pay taxes on a lot less money. So you don't have to itemize anymore, but you get the standard deduction deducted and then you pay taxes. So now if you were paying taxes, let's say you're in a 10% tax bracket or 12%, if you were paying taxes on $30,000, you would pay $3,600. But because of your standard deduction, you would only pay $2,000 in taxes. So it's a big savings. So that's why you got to understand what the standard deduction is. All right. So those brackets have really changed. They have increased, which again, this is very favorable. It means that we get to deduct more from our taxable earning if we don't itemize. If you're a single and married filing separate, that standard deduction is now $12,950. It went up by $400 from last year. If you are married filing a joint return, you get to deduct $25,900. That went up by $800 from last year. And head of household, which most people with a dependent, doesn't have to be a child, any dependent, you can file head of household. And that standard deduction now is $19,400. That went up by $600 from last year. Okay, so the increase in standard deduction, once again, is the amount of deduction that you can take off the monies that you earn before you pay taxes. And this is for people who do not itemize. So again, this is excellent. This is great. It gives you more to write off, even if you did not itemize and you paid taxes on less money this year. So this is very favorable, guys. This is excellent. Again, most of the time the tax changes is against us, but this one is very favorable to everybody that does not itemize. Okay, increase in standard deduction. All right, so that's the first point. I love it because it helps so much more people, because most people are in that bracket where they're not itemizing. So this is excellent. Okay, so that's the first point today. Hey, Margie, how are you? Good afternoon, Elaine. Good afternoon, Margie. Thank you for jumping in here. All right, so the second point today, guys, again, this again is very, very, very favorable. We love when the tax changes come up to be more favorable for us. The new tax bracket for 2022, and that the tax percentages, right? The maximum tax percentages is still 37%, and the lowest is about 10% that you pay on taxable income. But what happened, you know how everyone is like, oh, I'm in another tax bracket, and if I get a raise at work, it's going to kick me over into another tax bracket. So instead of paying 10%, now I'm paying 12%, or I'm paying 22%. What happens is the IRS have increased those tax brackets. So if you get a raise and the raise is $400, you may still remain in the same 12% tax bracket that you were in, and it would put you over to a higher tax bracket to pay more taxes. So that's what it means by increasing the tax bracket, which again, like I said, is favorable, very exciting news, and I just love this. So Miss Shreveport says, loving the info on how to save on my taxes. Thank you, thank you, thank you. Yes, of course. And so, again, the tax bracket. So let's say, for instance, if you was in the 22% tax bracket, right? If you was in the 22% tax bracket, meaning that you made about $41,000 last year, you would have paid 22% on the same taxes if you made the same percentage if you made $40,000. So now by it increasing to $42,000, there you are. If you was getting a raise of $2,000 or $1,500, your tax bracket wouldn't change. You still be in the same bracket of 22%. So increasing the tax bracket, that means you can make more money and pay the same percentage of taxes on those dollars. Okay. And for instance, if you're in the maximum, this is really huge. If you're in the maximum, say 37%, the increase is over $20,000. So you would have to make more than $20,000 between last year's tax bracket and the 2021 and 2022. You have to make more than $20,000 to really change into another tax bracket. This is, it sounds a little complex, guys, but it's so important. It's a lot of savings. And what it means is that if you make more than you did the year before, you have a whole bracket here before you pay a higher tax rate. This is why it's favorable. Okay. This is why it's favorable. So what they do with the tax percentage is the same, but the bracket is more so that you don't have to pay a higher tax percentage if you get an increase at work. And sometimes some people don't want to work overtime because they claim that, oh my God, if I make an extra $5,000, then I'm going to be in another tax bracket, then half of it is going to taxes. I'm not taking anything home. I get these stories all the time. People don't want to make $1 more. They're afraid that they bumped up into another bracket, and before you know it, most of what they make extra is paid out back into the taxes. So with the new tax bracket, with it increasing, meaning that you can make more money and still stay in the same tax bracket and pay the same tax percentage. So it allows those folks that was saying, I don't want another hour of overtime. I don't want to go from a 24% tax bracket into a 32% tax bracket because I'd have made $3,000 more and then paying it all back in taxes. So that's what it means by the tax bracket increasing, so you can make more and still pay the same percentage of taxes into the government. Okay, so that makes a whole lot of sense to me. Hey, Karen, thank you. Good afternoon. Good afternoon. All right. So yes. So that makes a lot of sense, guys. It's like I said, it's so favorable. It's very helpful. These tax changes for 2022 for the tax year 2021 is definitely on our side this time. And I'm really excited. Thank you guys over here at IG for jumping in. I'm really excited to deliver this message as opposed to tax rate increase and we're paying a whole lot more, right? So that's the second point today. Third point, you guys are going to love this. Those of you with dependent kids are going to love this. The third point, guys, is about the earned income tax credit. Okay. And we hear about the earned income tax credit. First of all, I want to explain earned income. Now, a lot of people want to know why they don't get earned income tax credit, but it's exactly what it says. You have to have earned income. So it doesn't matter if you have dependent kids, you must have some earned income to get this credit, right? This credit is a refundable credit. This is not money you pay into the government. This is money they give you back. So it is a refundable credit. So if you have, let's say, 3 kids, you can get up to $6,935 in refunds. You don't have to pay anything into the government. You can get $6,935 in refunds which is up from $6,728 that it was in 2020. So that increase. Now that, again, more money, it's more on our side. The taxes are a lot more favorable. This is excellent. So if you have 3 qualifying kids, guys, your earned income credit now can be up to $6,935. The year before was only $6,728. Okay, and all this is based on your income. Of course, you can't make more than, say, $51,000. There's an income bracket. If you make too much, then, because they try to make it favorable. If you make more money, then of course you get less earned income credit. Okay, so if you had 2 kids, for instance, you can get up to $6,164. And the year before it was $5,980. So you see, there is more money there for the folks with dependent kids, more earned income credit, more money in your pocket. This again is very favorable, excellent. If you have 1 child, you get $3,733. That went up from $3,618. So again, there is more money for you. And see, like I said, this is so exciting to share because what it is, because of inflation, the government feels that they have to make adjustment to the taxes, to the tax bracket. They have to make adjustment for standard deduction. They have to make adjustment for the earned income credit and many other things that they have been adjustment for that we're not discussing today because of inflation. So they wanted to keep it to where you are not actually having inflation, paying more taxes, right? Making the same amount of money and paying more taxes. So this was very favorable, and I actually do love these tax changes, guys. I'm so excited to talk about them today. And so those are the 3 that I wanted to discuss. The 3 that are the most common to almost all of us. Most American is within those tax brackets. So those are the 3 I want to talk about today. Okay, so if you guys have any questions on any of this stuff, feel free to put it in the comment below. I will respond to them now, or I'll come back through here and answer those questions. Again, this is very exciting stuff. Again, some people can get money back even if they barely work or hadn't worked, just have a few dollars in earned income. And I wanted to let you guys know earned income could be self-employment income as well. You don't have to have a job. If you had a business and you earn some money there, that is considered earned income. Okay, so if you have a business, there you go, earned income credit. You don't have to have a job and have to be working for someone who gets a W-2 for you to be qualified for earned income credit. Excellent. All right, so those are the changes I want to discuss today, guys. So let me go over these 3 changes, make some notes of this. Very exciting here at the end of the year because it's already in place. The IRS computer is already updated for this change, and it is a very exciting change for the taxes coming up. So some people is going to be excited to hurry up and file their taxes really early to get these refunds. And this is what you should do. You should file on time. You should file early, actually. Get the money in your pocket. Okay, don't wait forever. They want you to get the money up front so you can circulate it in the economy. So let's go back over the 3 changes that that I talked about earlier, guys. Number 1 is the new standard deduction. And just so you guys understand what that is, if you do not itemize, the IRS have in place standard deduction, which is the amount of dollars that you can deduct from the monies that you earn before you pay taxes. Again, you deduct standard deduction from how much money you earn, and then you pay taxes on the rest of it. Like I said earlier, the example, if you made $30,000 in standard deduction, if you're single, it's $12,950. You deduct that money from there, and you only pay taxes on $17,050. Okay. So that saves you about $1,600 in taxes. That's what standard deduction is. Now, people who itemize, they can exceed those standard deductions. They get more of a deduction, more of a write-off. So, of course, they pay, on whatever their taxable income is. So the standard deduction, very important for all of us who do not itemize. Number 2, the new tax bracket. Great thing. You can make a little bit more now and still remain in the same tax bracket. You don't have to be afraid to take that bonus check. You don't have to be afraid to work a few more hours overtime because it's going to bump you into another tax bracket. You don't have to be afraid of doing that. There's a little bit more leeway for you to stay within the same tax percentages without paying extra taxes on the extra money that you make. Okay, so this is awesome. This is great. Again, top tax percentage bracket is 37, and then it goes as low as, say, 10%. So once again, this is awesome, the new tax bracket, right? That's the second point. And third is the earned income tax credit. This is great for the people with qualified dependent kids. Again, you will get more money for your earned income credit. If you have 3 kids, you will get $6,935. That's the max you can get based on your income, of course, and based on the fact that you have earned income, right, from a business and any other type of earned income. And then if you have 2 kids, that number is $5,980. That number that was $6,164, up from $5,980. Okay, so there's an increase in each one of these categories. Guys, this is great. I can't emphasize how important this is for you guys to know this, because I'm sure I'm going to still get questions, because everybody's going to want to know why they can't get the maximum, or why they are why their earned income credit is reduced, because they heard they could get $6,935. However, there is an income bracket that you must be in. If you exceed $51,000, you will not be qualified for the credit. So there's some criteria there, but all in all, perfect, excellent tax changes, very favorable, very excited to share this information with you guys. Okay, so those are my 3 points today. Again, if you have any questions, put it in the comment below. And if you fall into any of these, I know everyone is in either the standard deduction. I'm sure that is going to affect a lot of people who are not itemizing. So you guys want to file your taxes early, get your refund, because it's going to be more favorable for you this year. And of course, the sooner that you get the money, the better off it is. And the government encourages you to file early so you can have that money to spend, right? They want the money to circulate into the economy, and they want that to increase. All right, so that's it for me today, guys. I want to thank you all for tuning in here today. Make me hit like and share on this video so everybody can get this information. And again, every Tuesday and Thursday, we got great information for you guys. This is all free. Most people have to pay for this info, but I just want you guys to have it, because the more you are equipped with this, the more knowledge you have about this stuff, the more you understand your taxes, right? And these are a few simple points. The more you understand that, the better off it is, and you can better plan. You can better plan how to save and how to take advantage of some of these credits and how to take advantage of some of these write-offs, which is what we talk about, and save on taxes. Keep more of your hard-earned dollars in your pocket. All right. So that is it for me today. I want to thank you guys again for tuning in here. And I will see you guys next Tuesday or next Thursday. I think we're heading into the holidays now. So this is great. Going into the holidays, going into the end of the year. All right. So I will see you guys next week. With that said, I want you guys to have a wonderful rest of your Thursday afternoon. And you guys take care of each other and take care of yourself.